All right, you're on.
Okay. Welcome, everyone. Thank you for joining today's call regarding condominiums and the many challenges we have in our industry and addressing issues there. On behalf of the MMBA and the Education Committee, I'd like to welcome everyone to today's call. The chair of the Education Committee, Srah Ruder, is joining us along with myself, the co-chair, and the moderator today. We have a fantastic panel, very experienced panel. And I'd like to just start with quick introductions and give you a little background of each panelist, and we'll go from there. So we'll start with Kathleen from Washington Trust.
Hi, good morning, everyone. I am the condo review specialist here at Washington Trust. I've been here 4 years. I've been in the business, I hate to even say it, 40 years, unbelievable. I've always been an underwriter. I was a manager at People's Bank for quite a while, and now I'm here at Washington Trust in my condo review role. Thank you.
Hey,
Excellent.
Kathleen, you started when you were like 5, so
Yeah,
that's yeah. Okay, just saying.
I was a special kid.
I'm just saying.
It's
All of us
crazy.
women folk did the same
Yeah.
thing.
Crazy. When I hesitated to think about it, I was like, wow, it's probably been more than that, actually. Yeah, because right 18, right out of high school, I started doing this. So that was that. I knew
Well,
somebody who knew a guy, and there you go. And I've been in the business.
how we all get in, back door.
Right.
All right. And Tonia from Movement Mortgage.
Hi, everyone. I've been in the business since 98, right out of college, started out processing, underwriting. And then for the past 15 years now, I have been reviewing condo projects, first with Mortgage Network and now here with Movement Mortgage. And currently I hold the role as a team lead.
Awesome. Thanks, Tanya.
You're
And
welcome.
Wendy from Embrace.
Hello. I have been with Embrace and therefore in the mortgage industry for 32 years now. Did processing, underwriting, managed sales teams, managed underwriters, managed closers. Now I'm vice president of operations support, and under that is our dedicated condo group for the last 13 years. So a lot of
Excellent.
experience.
Excellent. Welcome, Wendy. This is the only industry where I actually feel young at 20 years. So thank you for that.
Welcome.
And Pavels from Radius.
Hi, I'm an underwriter at Radius currently. Been in business 10 years, all at Radius. I just celebrated my anniversary this spring. I ran processing team for the last 10 years and been on the condo desk as an underwriter for the last 2 years or a little longer. Started right around the time when unfortunate tragedy happened in Florida and the condo world turned around. So I've been in the deep of it from the beginning of the new stringent guidelines. So I'm quite familiar despite less experience than others in here.
Welcome, Pavlos. Thanks for joining us. And last but not least, the leader of the Education Committee, Srah Ruder.
Thanks, Sean. Good morning, everyone. My name is Srah Ruder. I'm with Cape Cod 5 Cent Savings Bank on the Cape. And I was 5 when I started, so I've been in the business 25 years processing underwriting. I am currently the Director of Quality Control and Investor Relationships. I've been with the Cape Cod 5 for the past 13 years. So, and yes, I am co-chair of the Education Committee with my friend Sean.
Awesome. Well, thank you all for joining again. My name is Sean Fleming. I am a regional manager with Washington Trust Mortgage Company. I am also a proud board member of the MMBA. And for those of you that are involved with the association, we appreciate it. It's a very important piece of our industry, specifically in a heavy regulated state. So thank you for everybody's participation today. If you do have any questions, which I'm sure will come up, please put them in the chat and we will do our best to get to them at the end of the program. We'll be talking about 4 main kind of sections today, if you will. When it comes to condominium review, etc., we all understand, especially in Massachusetts, being the second wealthiest state in the U.S., that condominiums are typically the affordable option for most first-time home buyers. So this is a very big area for us. We're going to be talking about the insurance reviews with master insurance policies. We're talking a bit about the financials with the HOA and their budget. Also the condo questionnaire itself and some of the items that come up on there. And lastly, everyone's favorite, the critical repairs. That's been a hot topic, specifically the last several years. So to start off, master insurance policies. Srah, talk to us a little bit about the common issues that you see when reviewing master insurance policies and how they affect eligibility or saleable loan scenarios to Fannie and Freddie.
Thank you. So, reviewing a master policy or master certificate, comes with a lot of limited information. So trying to follow the GSE guidelines and making sure that you have all of the points that they require on that master policy is a challenge in of itself. Every insurance company is different in what they provide you. So, we find that, knowing that Fannie and Freddie require 100% replacement cost, that replacement cost is listed. I have noticed lately, ever since the GSEs came out with, oh, you must get a replacement cost calculator, which has stopped for the time being. I hear more to come. But I have been noticing that they've been putting in the comments section replacement cost coverage. So that has been helpful because you need to have that and not based on an actual cash value. We also notice a lot of high deductibles. Some of them are over that 5%, probably can afford it if they're large complexes and have that funds, but we also notice that on a per unit basis, that they are in excessive coverage. That is probably the biggest thing that we see here on the Cape. The borrowers can get an HO6 policy to cover that. I said the HO6, right?
Yes.
To cover that high deductible. Missing fidelity and bond coverage or not sufficient coverage. Also the liability coverage, insufficient coverage. Not that it's a problem, but lots of stacking going on lately where, you have a large condominium complex and not one insurance company is willing to cover 100% in that complex. So you do see a lot of layering lately, which is fine, but it's adding it up and making sure that there's sufficient coverage. I think those are the biggest things that we see for master insurance coverage. Any of my colleagues have any others?
So if you don't mind, the inflation guard is really one of the ones that's really killing me lately,
Yes.
with making sure there's inflation guard. And if it's not available, making sure it's just not available in the marketplace or, whatever the case may be. But I would say inflation guard for us lately, and obviously the per unit deductible has been a little bit of a tricky situation. And I know one of our biggest insurers around here, Brownstone, they don't even offer the inflation guard. So you got to get that up front, make sure. So it's just, my personal opinion is the insurance is becoming the hardest, even more so than critical repairs at this point.
Right.
And hopefully something will change.
In the per unit deductible, and I've seen that personally come up many times, and that, if I'm not mistaken, was kind of a shift to kind of shift some of the increased cost of the insurance, right? And kind of push it onto the actual unit owners themselves.
Yeah, many HOAs they don't realize when they add those per unit deductibles that they disqualify themselves from conventional financing, but there are ways to work around that.
Right.
And identifying that deductible, sometimes it just lists the deductible and then you need to know, is it on a per unit? Is it on a per building? Is it on,
per occurrence?
Per occurrence, making sure that you're not just making the assumption that this is per occurrence.
And sometimes you get lucky and they have an endorsement.
Right.
That week.
Already listed. Yep.
Right.
Yeah. So it
Well,
actually offsets and you don't have to have the borrower get that HO6 coverage, additional coverage.
Right, so the endorsement would have to say the sum of all per unit deductibles will not exceed 5%. And
Correct.
I do notice, I don't know about you guys, that's very acceptable, Fannie, no problem. But I had a problem, I had a loan kicked back for Freddie because they wouldn't accept the language. Now, this was maybe 6 months ago, maybe better, so I'm thinking that they're on board now, but I mean, that's definitely something I probably want to revisit. But Fannie for sure, does
Yeah.
allow the endorsement for sure.
Yeah, I had two instances in the last few months where, it wasn't clearly stated that endorsement is on the policy. And when we did ask the agents, they confirmed, yes, they do have that endorsement. And I was actually able to override the unavailable status with CBM by sending them
Yeah.
endorsement.
Right. I just did that too yesterday. I just did one like that. Right. But that's Fannie though. It's not sure about acceptable to Freddie. So if you have the instance that it got kicked back was we had an LPA run in the file. And that's why. And Freddie was just like, absolutely not, we won't take that. But I don't know. I'd have to reach out and figure out if they've changed their.
Well, Freddie does accept reciprocal review, so you can warrant it as Fannie and do it as reciprocal.
Yeah, true. That's right.
Okay.
Yeah.
And Tonia, how, from a lending standpoint, how do you approach the discrepancies between the master policy and the investor guidelines? Because sometimes what I see is that there's a big disconnect, if you
Right.
will, between the insurance policy says, this is fine, this coverage is more than sufficient, but then we're trying to explain to them, well, if people are trying to get conventional financing, it's not okay.
Right. So I think that, I think the first thing would be to, determining if a solution can be resolved first and foremost. And then, discussing with the HOA, board members, if you will, management companies, if you can. Obviously, it's always up to the HOA on whether or not they're going to make any changes, but it seems as if a lot of them have no idea that any of these coverages, the added endorsements that we need for condos, they don't understand that, we also have to look at that as well. And you can point right out, yes, I understand you lowered your premium, you have a better cost, but unfortunately, you're doing a disservice to the unit owners there for a refinance or who want to sell, and purchases coming in. And sometimes you can get at them and they understand it. But I think that's the biggest thing, education for them.
Yeah, nobody cares until they have to sell their own unit or refinance,
Exactly.
right?
Exactly.
Yeah. Okay. And Sarah, what ways can the lenders work with the associations or the agents to resolve some of these, insufficient coverage concerns? Is it sometimes you get lucky and it's based on timing because the policies typically, the 1-year policies, and you just happen to come up on a change policy. But other than that, is there anything that can be done?
Sometimes there can. I think Tonia talked about that, talking about it with the HOA and the management companies to see what they can do to make the policy eligible for Fannie and Freddie. Sometimes, they have to go to board meetings and things like that. They can't just change things on a whim. So that's sometimes
Right.
not easy. But, explaining to them the importance of it, that, if you have other people that sell, that they might not be able to get a conventional mortgage the way that the policy is written now because of this, that, and explain to them. Now, as lenders, we have to be insurance agents as well, but talking
Yeah.
to the insurance company as well to kind of bring them into the loop, and they sometimes can explain things or things that aren't on the policy that aren't on the certificate that are in the policy. So sometimes you can resolve it that way, but most of it is that, you need the HOA to have a meeting and get people to buy in on making those changes so that the properties can be sold for conventional financing.
Yeah.
Right.
Yeah, I think that's a great point in education and educating the board members, the management company, and the impact. We're not just trying to be difficult and we're trying to
Correct.
make life easier for them, allow their units to sell and for the association to prosper. So I think that's a great point. Pavels, any red flags that you see particularly on master policies that the lender should be mindful of?
Yeah, I think we touched on some of that, but as Sarah mentioned, biggest thing is, cash value. Agencies are very strict about replacement cost. If you see cash value anywhere, it's a big no for them. For example, I recently had a condo that, certificate had replacement cost on building, and they couldn't find the several coverages that are required. And when that happens, we ask for full policy, right? And when you do get full policy, you have to review the whole thing. We looked at the full policy. Turns out that despite the building being replacement costs, their roof had endorsement that's cash value only on the roof. Possibly, it's an older roof, and when they shop for insurance, and they were like, you would save money if you insure a cash value only, because older roof will cost a lot to insure for replacement cost. Well, that instantly disqualified them, and in that case, we had to go back to the board and let them know that it's not warrantable, not even with Fannie or Freddie, and no one usually with insurance, even non-warrantable investors will not even touch cash value stuff. So we were successful by removing that endorsement, but again, like we just talked about, it's all about communication. You have to effectively communicate to the appropriate people why something is needed, and what's the real impact, right? If it's the borrower, why is it a problem that it's cash value? Well, that cash value of the roof, of the 40-year-old roof, is not the same as the current replacement cost. So if that roof starts leaking, then it's a potential huge burden for the HOA that they will have to cover outside of insurance.
And I've also heard from HOAs too, in regards to the actual cash value, that until they replace the roofs, it's really hard for them to find insurance that will do it at replacement costs and
Right.
not the actual cash value.
Can you explain that, Tonia, real quick, in
Wendy-
basic terms, the cash versus the cash value versus the replacement cost, just the basic understanding so people know?
Yeah, so they're only gonna insure it up to the cash value of the roof right now, and not the replacement cost of the roof as if it was, new
Okay.
or of age. And if I said that wrong, guys, because I'm not an insurance agent. And I know you guys aren't either, but if I said anything of that incorrectly,
Effectively, what they do is take the replacement cost and then subtract depreciation. So think of it like your car. As soon as you drive it off the lot, it's worth less because it just continues to depreciate every day. So that's what happens with the roof coverage as well. It's that depreciated value.
thank
Just
you,
left
Wendy. You said that a lot better than me.
And not that we're talking about homeowners, but we're seeing it on homeowners policies too, the
Yes.
roof
Oh,
Okay.
wow.
inclusions.
Yeah.
Interesting.
Especially in the Midwest.
Yeah.
Another red flag I would mention that I ran into a few times recently is not cash value, but agreed value on the building. Agreed value is also similar. I mean, sometimes it can be based on replacement cost, but sometimes it can be just agreed value. How much do you think this building is worth? Okay, $1 million, fine. But it doesn't mean that it's replacement cost. So I've had instances where we've had to ask for replacement cost estimator. It's not an easy thing to get for entire complex.
Mhm.
And I've spoken personally to Fannie Mae and Freddie Mac. They don't recognize agreed value as anything unless it's replacement cost. So that's a red flag too. If you see agreed value, you have to investigate that.
Okay.
I've actually had luck with investors getting the condo declarations. And if the insurance section spells out 100% replacement cost is required, I'll put that in the file to show, because the condo docs are recorded. Those are the condo docs. And I've never had a loan get kicked back because of that. I better be quiet. I probably just jinxed myself. But yeah,
Thanks.
I'll do that all the time. Like because the replacement cost estimator is so difficult to get. And you know, they never put 100% on the thing, on this certificate. They never will put that. So, you know, now I just order docs, you know, when I can, because usually they're not much more money when you're ordering the condo cert. And then I just find the insurance section and I just stick that in the file and say, here's 100% replacement cost. And though I always make sure it does say replacement cost on the certificate. That's provided that it is truly replacement. To your point, agreed and actual do not work. Yeah.
Yeah. So if certificate doesn't list it, then obviously we have to do more investigation. So just be mindful of that. Like there are ways to work with it, like getting you know, alternative documents. But if you see those cash value, guaranteed value, you need to raise your hand.
From a sales side of things, would you recommend, and I know there's only so many things that an LO can do up front to make sure that the condo would be warrantable, would you recommend them obtaining or requesting a copy of the certificate of insurance? I know a few of my LOs have done that. Okay.
Absolutely.
Yeah, many HOAs, they have a sample certificate.
Right.
You don't even need to get it with your, you know, mortgagee or your borrower on it. They have sample certificate that should list all the coverages. So that's a good starting point. And the realtors usually even provide that to the borrower.
Okay.
Right, Sean. I mean, to your point too, you know, just to bring this up too, the file comes in, you don't know who the agent is. So now you have to order the condo questionnaire and you have to wait who knows how long to even find out who the agent is to request that certificate. So now if there's a problem, now it's even another week out because you don't know that. I mean, it would be great if we had a certificate up front, because at least we can, even if we could just knew the information and the contact at the same time that we knew the HOA contact, that we can order both and at least get them at the same time. Because I'm always waiting. I have the condo questionnaire. It's clear. Now I got to chase down the COI when I could have been doing them both at the same time. So that would save a loan officer a lot of time and effort.
Yeah. For any loan officers on the call, I always try to explain, especially to first-time home buyers, because this stuff is obviously very overwhelming, is that not only do you as the individual borrower need to be approved for the financing, but the condominium also needs to be approved for the financing. So, you know, kind of setting those expectations up front that there's some things that are outside of my control that we'll have to just work through as we go through the process. There was a question that came up, and I do think I'm correct in the fact that 2 to 4 units, Fannie and Freddie are exempt from the standard review, but from the insurance piece, because I think that what is required, or what are some challenges, if any, on the insurance piece on a 2 to 4 unit?
So on a 2 to 4, it's I've actually had the Fannie clarify that you still need master insurance, and then it'll depend on your LTV as to whether it falls under limited or full, right? So if you have a 2 unit at 95 LTV, you're gonna want to see everything that full warranty requires on master insurance.
No, I'm confused. No, you don't have to warranty a 2 to 4 at all, even if it is 95.
Yeah, just the master insurance requirement.
Right.
The master insurance, okay.
Yeah,
just
for
make
example,
sure.
on limited review, you don't need any liability coverages.
Okay.
Right? And full review, you would want, you know, everything that the full review would require.
Okay,
I'm sorry, Sean. Sometimes on 2 units, I'll see where they have 2 separate policies. So like they'll say it's only a 2 unit. They each have their own individual. There is no master HOA, and that's fine. But then I always want to see the docs to make sure the declaration.
I was just going to say that,
acceptable. If not, then either we need the policy or the docs need to be changed. So that's one thing I run into. Usually when it's only a 2 unit, even a 3 unit. Usually a 4 unit have an HOA, but a 2 to 3, sometimes they do their own thing. And they don't realize they can't do that because they're not following the doc.
Yeah, we run into those problems. Again, yeah, declaration of trust on 2 units. If you get indication there's no master policy, we need to get that as soon as possible. Because again, declaration of trust, tell them what they need to have. There is a way to amend it, declaration of trust, but it's a recorded document. Again, an attorney needs to
Yeah.
rewrite it
Yeah.
and re-record it for us to change the requirement.
That's a great point. I mean, I've seen some that have lived in the property 20, 25 years. They've
Right.
always had their separate coverage, but then you look at the condo docs, like, well, according to the condo docs, you're supposed to have a master insurance policy. And if you want to sell your unit now, they're going to need one. So
They have
it's
a
time.
master for the liability only. Sometimes they'll have a master just for the outside, and then they'll have their own HO3 for the inside. But again, the docs dictate what they
Gotcha.
should have.
One last question on insurance, and this might be a loaded one. Sarah, I don't know if you want to take this given your location of employment, but a question came in about challenges with flood insurance policies for condos.
Yes, flood insurance, my fave. Well, I think that might be based on how you determine your replacement cost coverage for condos on flood. So what I mean by that is that if your flood policy lists a replacement cost value, that is what we use first, is that coverage amount and then divided by the number of units. I will say the biggest thing is that when you are reading that deck page, make sure that it is for the building and the unit in which is being covered. Sometimes we get a policy and you're looking at it and you're like, yeah, everything looks great. And then you're like, wait a minute, this isn't even the correct unit, because sometimes there are several policies because only the building needs to be covered. So you may have one building in the complex that's covered and one building in the complex that's not covered. So even getting your flood determination to make sure that they provided you a flood determination based on that building specifically in that unit, because sometimes if you're not specific, they will provide you the highest value, the highest flood in the complex, and you got to be more specific. So that is probably the biggest challenge, is making sure that the unit that you are financing, you have the correct flood policy going with it.
Page,
And
yeah.
then if you use the replacement cost, I haven't really seen a lot with the replacement cost, but then if the replacement cost doesn't, then the borrower has to get supplemental coverage for that unit if there is insufficient coverage for that unit. Anybody else?
Great.
And then I just wanted to add, for loan officers, maybe even loan officer assistants, there is a great tool on Fannie Mae. You can just Google it, the Fannie Mae flood calculator,
Nice.
and you can just plug in all your numbers and it'll tell you whether or not you're compliant, if you need gap coverage. I like to include that in the file just in case there is gap coverage so that everyone's aware. And
And the
Awesome.
other factor too is you only, excuse me, need to have up to 250,000. So if your replacement
Right.
cost is over that, you only need 250 per unit in that building.
Right.
Okay, that's good. Good to know. Awesome. All right, so moving on. So not only do we need to be insurance agents, but we need to be CPAs. So let's talk about financials, budgets, reserves. I know these are all big items that come up specifically with full reviews on condominiums, not necessarily the limited reviews, but full reviews. So Kathleen, maybe you can talk to us a little bit about some key financial indicators when you're reviewing an association's budget and the reserves that kind of provide, first and foremost, what you need to be looking for in order for the association to meet Fannie and Freddie guidelines, and then maybe some other items that come up as concerns.
Sure, thank you. So of course, a condo is ran like a business, right? Like any other business. So when you're looking at the budget, you're looking at the financial health of the association. So I start at the top, and you have to see how much the condo fees are. And then you have to find the reserves, and the reserve should be 10% of the condo fees, the HOA fees. What else I look for is special assessments. Is there any special assessment listing on there? What's the special assessment for? Now that's going to lead you down the path of, well, we had a roof put on. Well, is the roof deferred maintenance? Now we're back to critical repairs. is the roof deferred maintenance, or was the roof a capital improvement, or whatever the special assessment is for? You're going to want to know what it's for, if it's been repaired, how much it is per unit. Is our unit paid? If it's not, we have to add the special assessment payment to the debt ratio. There are some things that you can exclude from the budget. You can actually exclude trash and the water or exclusionary items. I usually don't exclude them unless I have to.
Right. Absolutely necessary.
Why? And then I kind of look at the bottom line. Like, you want to know, is there any loans out? Do they have any loans out? Is the insurance premium being paid? If the place is in critical repairs, what does the bottom line look like of that budget? Can they fix the repairs? Is there money there to any leftover money? How much is in their reserve account? All these things play into the big picture of what it looks like. If you're looking at a budget and they're in the negative, you're going to want to question, why that is. And if they're in the negative with needing a new roof, you got two things going on there. Well, where's that money coming from? Then, you have to ask the questions. Are they going to get a loan to do these repairs, or are they going to run out a special assessment? And again, when's it going to be? What's the amount of what's needed for the repair? That's if there's repairs. If there's no repairs, no special assessments, no loans, that's fine. Then you're just looking at the general health of everything and making sure. I always make sure that insurance premium is paid, because that's a really big nut to crack. And if it's not, if it's not on the budget, you want to know why. Where that premium is. Yeah, just like you would do your own budget, right? If you had your own business or anything like that. And then I always kind of want to take a look at the reserve account too. They have to allot the 10%, into the reserve account, unless they have a reserve report. Sometimes we'll have a reserve report done in the last 5 years, and the reserve report will dictate how much they need to put in every year. Sometimes it is less, but you don't see that too often. So normally you're always looking for that 10%. And then again, depending on the situation, if there's any critical repairs or anything like that, then you're going to want to know how much is in the reserve account, because the budget doesn't show you the balance. It just shows you what they're putting in. So sometimes you have to take the extra step and say, well, what's in the reserve account? Like when we look at port loans, that's the first thing that I'm always asked. Well, how much is in the reserve account? We're going to take a chance, put something in port because maybe it's something minor. And then, I always have to dig a little deeper.
I would also add to look out for loans on the budget, just
Right,
like
that's
special
it,
assessment. It's another indicator that they may have something going on.
Right. I mean, I actually had a condo not that long ago. The HOA called me. It was a young girl, and she said, "Tell your borrower to run." She said, "I came in this place with high hopes." She goes, "I'm just out of college. It was in Boston somewhere." She said, "The roof is falling down. Everything is falling down." She said, "The person before me embezzled the money out of the HOA." She said she was an old lady. She stole all the money, older woman, like 100 years old or something, took all the money. And she said, "Now everybody here is a senior citizen." She said, they can't afford the HOA now. I can't roll it. She was like, they're not even paying their regular HOAs, let alone special assessment. The place is falling down. Yeah. So yeah. Hello, Fannie Mae critical list. Yeah. So we ended up, telling the borrower, and then you want to educate your borrower, right? You don't want a borrower getting into that. They might not even see those things.
Right.
So to me, without us, backing them up, we're doing your borrower a service by backing them up and letting them know. If they decide from there, if we're okay, and they say, yeah, we don't care about that, then that's fine. But I had another one. There was a $10,000 assessment per unit for an elevator, and our customer was on the first floor. So, they didn't know it was coming. We let the customer know, and then they can make the decision whether they want to proceed or not.
And when we're looking at the budget, requesting a budget, is that typically this year's budget, last year's budget, next year's budget?
For 2025,
Yeah,
yeah.
you're current.
Yeah, current.
Yeah, the 10% allocation for the reserve line item is always been very interesting to me because years ago, whenever Fannie and Freddie changed those guidelines, I started noticing over time that every association had exactly 10% allocated. And I thought to myself, wow, I mean, everyone feels like they only need to allocate exactly 10. They don't need 9, they don't need 11, they need 10. So I found that very interesting. But that is something that does come up in most associations. I think over time, at least that's one that I think they've all come to understand for the most part, not all of them, most of them, that they do need that allocation, really, regardless of the reserves. Is that correct? Regardless of the balance?
Yeah, regardless of the balance, right? Like I said, that would be the next step if we had to dig. But if they're not putting 10% in, we always want to know why. Why? You know what I mean? Because they should at least be able to put that in. A lot of times they put in a lot more. But you know, if they're only at 1% or none, like I've had a lot of them say, we don't have any money. We don't have the extra money for reserves. And then that's when we start questioning, well, now it's unwarrantable. And you know, what are we going to do? Or sometimes they'll say, this is what happened. Our reserves were depleted or something happened and we're trying to get back there, or sometimes they'll give you a reason that makes sense. But again, with agencies, it's cut and dry. It's 10% or nothing.
Understood. Anybody else want to add anything to that?
I was just going to say on the smaller projects, sometimes like always goes back to education. They feel as if they're small. They don't really do that. They don't put anything away for reserves. And, you know, unfortunately, you must, depending on your loan program. And then, what else was it? Oh, forget. Oh, I see a lot of, maybe with the newer projects or when I'm talking to developers, they really think that they can make the budget based on expenses and not income. And that, you know, sometimes you have to teach them, no, it's the other way around. It's not the 10% based on your expenses, it's the 10% based on your income per the GSEs.
Yeah.
I see that a lot too. Yeah.
Great point.
And
Yeah,
one out with new construction, Freddie Mac allows as long as there's a 2-month deposit
Yep.
from each of the new buyers that's going to be going into the capital account. They will accept that versus the 10% line item on the budget.
Right.
Okay, great. I think it's a great point, Tonia, about you know, the budgets, even a 2 to 4 unit, you know, it's exempt from review. So technically we're not looking at a budget, but if you are an owner there, you really should consider setting up a budget and having some type of reserves, right?
And sometimes a 5 or a 6 will think they're like a 2 to 4 and say, oh, when things come up, we just talk to our neighbors and we all figure it out. And unfortunately, per the GSEs, we have to review you just like every other 100 to 200 condominium project in regards to reserve.
When that one neighbor says, I don't have it, and now
Yeah.
everybody else got to pitch in for that one neighbor, and now,
Yeah.
you know, whatever, your borrower can't afford to live there anymore because, you know, Joe next door didn't have 10,000 for the elevator or whatever. Yeah.
Now, if the budget or the reserves are underfunded, especially the line item for the allocation, let's say it's 8%, is there anything that can be done at that point, whether, you know, through a recommendation, through speaking with the management company, the HOA? What kind of steps can we all take to help educate them or make any adjustments at that point? Or is it just, hey, wait till your next budget, you're unwarrantable till then?
I was going to say that's usually how HOAs approach it when I ask those questions, just because, you know, they have to have a meeting. It's already been approved for the year. So that's kind of hard, but you know, that's sometimes is when we have to look at other investors that we have in-house that, you know, you might have a rate hit, but
Right.
we'll take a lower.
Right. Let's see if we can put it in for.
Correct.
Yeah.
If you have a
Well, one
higher
thing I
down
want-
payment, you can do a limited review and then you
Right.
don't have to go by the budget review. So that's another conversation to have with the consumer.
That's a really good point. Yeah.
Very good point.
One thing I wanted to mention is that there's such thing as exclusionary items in
Right.
the budget, right? So you have your income, and then you have things that are included in the HOA fee. It can be things as water, trash removal.
Trash.
It can be even utilities in some cases. And for large projects, those can be large bills. It can be $40,000 in water, right? And when you have proof that it's included in the HOA fee, you can exclude that amount that you see on the budget, for example, for water, from your income. That makes your 10% amount smaller. So sometimes I'll see a budget that has reserves of only 9%. It's like, what are we gonna do now? Next step is to look at those exclusionary items that
What's
usually
included?
right over the 10%.
Right, they're water, sewer, and trash, unless the appraisal says that it's included other utilities. But for the most part, those are the three that you can deduct.
That's a great point.
And to your
And-
point, Pavel, yes, sometimes they're huge, right? They're $40,000-$50,000, and if you're that close, that will get you there.
Right.
Yeah, like we talked, a lot of HOAs, they know the rule, right? And they get just to that 10%.
Right.
And some of them get to that 10% with exclusionary items because they're aware of that. So if you initially look at it, oh, it's only 8 or 9%, you won't realize it's 10 until you add those back.
Good point. And does anyone want to just touch on briefly the limited review versus the full review in regards to the budget piece?
So with a limited review, you're not required to review the budget. So that's an easy out
Mhm.
to get around that restriction from the GSEs. So you're just going to be for a single family primary res, that allows you 90% LTV.
Excellent. And I think there's even some investment scenarios, I believe, with the larger down payment do allow limited, if I'm not mistaken, as well.
Right, 75%.
75. Okay, great. Yeah. Excellent. Someone mentioned the special assessments in being a potential red flag. When we see the special assessment specifically on the financial piece, how does that, influence the underwriting decision? Wendy, if you want to try to take that one.
Sure. Similar to what Kathleen had said, you want to look to see what the special assessment is for. If it was to overcome a big increase in the insurance premium, probably not going to be that concerned about it. They're doing the right thing by making sure they have the right insurance coverage. So I'm not even going to blink twice at that. But if it's a large assessment and the reason is they're not maintaining proper maintenance in the project, so now we're into the critical repair area, that's when you want to do a little deeper dive, looking at the information. If they've had a reserve study or an inspection done, you want to get copies of that and review those. And for those HOAs where under legal counsel, they will not share that information, then you want to try to get meeting minutes. And if they're still not going to give you something, you want to be concerned about what's going on in that project. Additionally, what we'll also consider too is if it's a matter of they're considering doing a special assessment because there's a large roof replacement project that's coming down the road. If you have a consumer that might be an affordable borrower and they're under 80% AMI, you might want to warn them and look at their financial situation. Like, hey, moving forward, this might not be an financially feasible investment for you.
Right.
And we'll give that information to the loan officer so they can have that conversation with the consumer on whether they want to continue down that road or not. Because besides the borrower safety, you're also wanting to protect them from putting them into a bad financial situation, because that's going to hurt them just as much, if not more.
Same,
Yeah.
yeah, same process with the loan. Like if I see a outstanding loan on their budget, I'll question that sometimes too. I'll be like, what was that loan for? Are they, again, back to the deferred maintenance? Because that loan is hitting everybody. Everybody's paying it back, whether it be through a special assessment or a loan. You kind of always want to look at those things for the same reasons.
Right.
And then the other consideration you need to take also is, are any of those special assessment payments delinquent besides
Right.
the regular HOA assessments? So if the unit owners are not able to make those payments, that is an indicator of some potential financial issues for the HOA as well.
Right.
If what is it, 15% or more than 60
15%.
days behind on the
15%.
assessment, it's no go.
Yes.
It's unwarrantable.
Yeah, and a big takeaway for loan officers on the call would be, because I get this a lot. Well, I have a limited review. Who cares about the HOA fees being 15% delinquent or not? This is not on the HOA fees, regardless of a limited or a full review. This special assessment requirement, when there is one, is required on all loan types.
Yeah, and I think we're all obviously in our roles protecting, we're protecting the lender, but ultimately, these reviews protect the buyer and make sure that they're fully aware of what they're getting into. Someone had mentioned with the special assessment, making sure that if they're taking one over, the buyer needs to qualify with it. I think I've seen in certain circumstances through negotiation that the seller, pays off the assessment.
Yep.
In that case, that's acceptable and at least their portion.
Yeah, you wouldn't have to put that in the DTI.
Okay. All right. Let's see, Tonia, this is back to you here. How can lenders balance the regulatory requirements with actual realities when reviewing the association financials? I think we've kind of
I think we
touched on
touched on
some of
that.
this.
Yeah.
Yeah, I think we've touched on some of this. I don't know if there's any questions that come on in regards to the budget, but a lot of good comments here, a lot of things to look out for. Would anyone on the call recommend, from a sales perspective, with a loan officer going as far up front to actually reviewing some of this stuff themselves?
Absolutely.
Okay. Any recommendations on how to get access to this stuff without having to order the full packages?
You could
I feel
talk to
like-
their realtor. Their
Whatever.
realtor
Like
might,
budget is
might have
one
access to
thing.
that.
Yeah,
Or
budget
it's
is
a
one thing that realtors will post on the MLS as well. It's probably biggest thing for a borrower to see, because they don't understand much about what's going on in the questionnaire, but everyone wants to see that the place they're buying is financially stable. And I always tell the borrowers, make sure they saw the budget.
Yeah.
And
Yeah, because they
Google is
could
your
start out
friend.
with they could start out with a $400 HOA fee, but based on financials, who knows what's coming up?
We'll even
Yeah.
just do a straight out Google search, see if anything has been commented, and whether it's a local newspaper on issue, like for
really?
larger projects. Sometimes that stuff comes up and we're able to backtrack that. Or if the HOA has a page that's not private,
Yep.
you're sometimes able to find meeting minutes and so forth there.
Yeah, I have a good friend who is condo shopping right now, and he's sending me some of the listings he's seen. Most recent one was a 6-unit condo, and their HOA fee was $640. So I was like, how's that? That seems a little high. I'm like, yeah, like try to add up some of those things that usually go into what's included, water, right? The trash removal, snow removal. How much do you think that stuff costs? Probably 200-300 tops per unit. So ask them where the rest of $350 go.
Right.
Again, from a sales standpoint, I sometimes try to do some of my own research and really ask the question, but with the registry of deeds, find out if there's been any recent sales, right, in the association, because the realtors and the HOA, they'll love to tell you, oh yeah, there's been plenty of sales, but well, the last 5 people purchased cash, right? So obviously we
Huge
didn't go
red
through
flag.
we didn't go through the condo review, or they've they've all financed with a specific, bank that's known for portfolio lending or what have you. So every scenario is case by case. I try to, be as proactive as possible, but this is all great information for everybody to be aware of regarding the financials. Anything else with when you receive a full financial package? Obviously, the budget's most important. Is there anything else that we're looking at within that package?
I think we covered it pretty well.
Yeah, I
Okay.
think we did.
Awesome. All right, so moving on to the questionnaire review. Pavels, which part of the condo questionnaire tend to raise the most concerns or questions for you? And maybe you could touch on a little bit of, whether and it might be case by case, whether you're ordering a specific condo questionnaire to Radius, or whether you're using a Fannie Freddie one, or whether you're just receiving whatever the management company or association is providing.
Yeah, so I won't talk about the structural addendum just right now because we have a separate section dedicated to that. It's that important and not many red flags are there. But I'll talk about the questionnaire itself. As far as what questionnaire to order, I would say that if there is a management company, and they use a high profile service such as HomeWise, their standard questionnaire usually includes everything that your questionnaire will include. It's generally a lot less the cost of the questionnaire to get that standard questionnaire. It takes less time because a
Right.
lot of times if you send them your own, they will have to send it to their lawyer because, as we call them, they like to get lawyered up. So I would say standard questionnaire is a good start with most of the management companies. Obviously, if you have a small HOA, you have no choice but to use your own questionnaire. So that as far as the type of questionnaire that goes. That said, both limited and full reviews do require the structural addendum. So you have to make sure that questionnaire you're getting has structural addendum. Some management companies will clearly say, this questionnaire will not include structural questions. That's the problem. Then you have no choice but to send them your own, or they will have a separate line item for structural addendum. Make sure that's included. As far as red flags go, we touched on one that's really important, right? Delinquency rate. It's not just assessments, it's the regular HOA fees as well. If more than 15%, 60 days or more delinquent, then you are ineligible. Single entity ownership is a big one. And I see that that can be a problem usually with smaller projects because the requirement is stricter. So on a project of like 21 plus unit, it's 20% off the whole place. So it's pretty unrealistic that, a large project, someone owns more than 20%, but it happens. So you always want to look out at that. On smaller projects, under 20 units, if someone owns, 2 units, it's already a problem. So you have to look into that. Pending litigation, everybody loves that. Pending litigation, huge red flag right away. You need to, if they then provide contact with that attorney, you got to get that right away. Find out the nature. Find out if they're plaintiff or defendant. If they are the plaintiff, it's probably not a big deal. If they're defended and there's a personal injury, you have a lot more to uncover. You have to ensure that their insurance is representing them, that they're ready, they have sufficient coverage to cover that claim. So there's a lot to find out when you have a pending litigation. It can be disqualifying. Owner-occupier ratio can also be a problem, primarily on investment properties. If you have investment properties, 50% must be owner-occupied. But for us in Massachusetts, If you do a mass housing loan, which is a pretty popular option now, especially since they revised their DPAs, they're less restricted. So I imagine a lot of people are using mass housing now, regardless of what kind of property they're buying, even primary residence. They cannot have more than 50% of investor occupied. So that's important to look out for. Commercial space is another one. You know, it can't be more than 35%. I think that's Freddie, and maybe 25% Fannie. You know, if your project is primarily commercial and just a couple of units on top, that's a no-go. So those are, I would say, the main red flags on your standard traditional questionnaire that I run into.
Yeah, you covered a lot there, which is great. And just to be clear, the owner occupancy ratio, because I do get this a lot, when it is a primary resident and it's a Fannie Freddie non-mass housing, the ratio itself does not matter.
Yeah, it's not an issue, only if you have a mass housing loan.
Yep. Okay. Excellent. And you talked a little bit about the actual questionnaire, specifically when they're using a management company like a HomeWise or a service like a HomeWise, and you're receiving the questionnaire. It typically covers most things. Now, if it's a limited review, but you're receiving the questionnaire, the full questionnaire with everything, and for example, within that full review, the allocation for reserves is less. Is that something that you're not worried about because it's a limited review, even though you have all that information?
Yeah,
Just
it's not a
ignore it.
problem.
Okay.
If it doesn't apply to the review, that information we can safely ignore it. Well, again, you see something really glaring, you might want to let your borrower know they're not getting into a great place. But as far as guidelines, no.
I just want to
Excellent.
circle back a minute
Yeah.
on the budget too, because you mentioned something that you thought about it. You can't have more than 15% of your income coming from non-incidental.
Right.
So you can't have like a golf pro shop there on your property that's bringing in more than 15% of the HOA income. That's also.
Thanks for adding that. There's a question I think that Sarah had indicated, and the question primarily has to do with overcoming the challenge of obtaining the questionnaire and the budget from the HOA. And the question is in regards to, if you ask, do we get the realtor involved, the borrower, and you know, what kind of successes has everyone had in regards to that? Because obviously the cost of obtaining these can be pretty expensive as well.
Yeah, we'll usually communicate immediately with the loan officer and the processor, let them know exactly when the order is going out, what the cost is. If when the information comes back, usually you're not getting the inspection reports or the reserve study that they've indicated that they have, so you have to go back and ask for that again. And letting them know that, okay, we reached out, they haven't responded. 2 days later, we reached out again, they're still not responding. And you know, the third time, you might want to get the realtor involved because in the seller, because this is causing a delay. We cannot proceed without this information. And we're just on that as soon as we can. And having all the right contact information in the file is critical for all of our condo departments to be able to do their job in a timely manner.
What I see a lot of times too is in the contact, it'll be the realtor. So the realtor is not the person. So now here I reach out to the realtor, 2 days, 3 days have gone by, the clock's ticking. The realtor turns around 3 days later and says, oh no, it's not me, it's condo whoever. And then you order it through condo whoever, and they said, oh no, we don't accept the credit card, we only accept the check and you have to mail it. You know, so now you're like, I don't even know how many days out, and you could have saved the first couple of days. You know, I just wish that people would just put HomeWise, you know, condo cert. I mean, I don't know if there's any way to solve that, but I always have some odd name or just a person's name, and it very rarely is it the right person. So then that definitely slows down the process in the beginning.
Yeah, we have a policy at Radius that,
Correct.
you know, our processing staff, our condo department will be on top of everything condo. Very important from the moment the file is disclosed. But one thing the loan officers must do, get that contact, get as
Get the
much as
info.
possible, what's easily available to you. That way we all can get a head start. We cannot have a head start if you don't get that contact.
One of the loan officers, I'm not going to say who, but him and the processor work together. And when I get into the file, everything's there. You know, I'm not saying that I want them to do my job, but a lot of times they've already reached out to the realtor. They're like, here's everything you need. Here's the condo questionnaire. Here's the this, before they even submit it. And then all I do is review it, update the insurance, and it's done. I mean, that's a perfect world. And then I would probably be out of a job. But it is very helpful, and it turns it around so quick when you know, even if I just have the insurance information up front, but
Well, sometimes too, I find, Kathleen, when a loan officer or loan officer assistant does that and gets the documents up front and you have them, it gives you a lot more time to actually do the actual underwrite, because you're not chasing and underwriting, chasing, then you know, so
yeah.
I think
It's a nice little package, right? It's like this nice little
you just put the bow on it. You just put the bow on it. Yeah.
I love it. And I'm like, oh my goodness, what they need to do is a request, you know, whatever. And especially the questionnaire is already in there. And a lot of times it wasn't hard for them to get. A lot of times the realtor had it, or if it's a refi, the borrower had it, but nobody ever bothered asking for it, you know?
Right.
Yeah.
Now, with the increased push on technology and leveraging, you know, automation and findings and, you know, income assets, maybe even appraisal, etc. Have we seen a change? And a few of you, I think, noted in our prep work for this about Fannie and Freddie having some indication in their findings on the association, and whether that association has already been through a review and if the review is still valid.
Yeah, so CPM has recently been integrated into DU findings. So if you have unavailable status on CPM, means someone reported a critical issue, findings will give you approved ineligible, and that's a hard stop. You cannot proceed with the loan until you resolve that.
Right.
Someone said, I think Freddie's following the steps to implement that in the near future as well.
And CPM is condo project manager, in case nobody and people aren't aware of what that is. That's Fannie Mae's right, condo Bible, pretty much. So the first thing that I think we all do is we check CPM to make sure that status is available. You don't need to actually run a CPM. Now, if you have a full doc review, you actually have to go through the process of running the CPM, which is like 5-page kind of questionnaire that you have to answer. But for all files, they need to know if it's available. So when it's a limited review, I just go in, make sure it's available. It's not on their critical list for anything. And then I don't put it in the file. I put it in my file. I don't put it in the actual file because it's a limited review. And I found that when I put it in the file, I had investors saying, where's the rest of the review? And then I'm like, it's a limited. I just put it in there to show you, you know, so, but I always make sure, because somebody's going to check it. But if it's a full review, then you need to run the whole CPM yourself and get it certified in our name. Yeah. Yeah.
At Radius, we have condo desk, and we encourage all of the loan officers to ask as soon as possible, as they know they have a condo coming, even if it's not a signed deal yet. If they know that it's pretty certain that we have a condo, you have the name of the condo, reach out to us. We'll look up the CPM. That way we can get ahead of things a lot quicker. So if you have some sort of deal desk or condo department at your company, do that when you know you have a condo coming. It can save a lot of trouble.
I am the whole condo department. Me, myself, and I, all three of us.
We also run
for the loan officers to be able to get CPM access. You know, it's a 1-minute process. It's not like it's a hard process. then when they're talking to the borrower, they could be looking at it and saying, you know what, we can't do this. It's unavailable and this is why. And don't even bother going any further. The earlier we nip it, the better off we are in the process.
You
So
sometimes
just
get lucky that it's Fannie Mae approved. So the only thing you have to worry about is your insurance. You don't
Right.
have to get a questionnaire. That's
Right.
the golden ticket.
Right,
And
right.
Freddie Mac has their own, it's called PAR.
Yep.
So they are now actually doing the same thing as Fannie Mae, and they have some already approved projects, so you can skip the whole dot gathering and only have to address the insurance with them as well. We check that on
That's
we
great.
check both on every conventional loan.
Yeah.
That's
That's good to
great.
know.
Yeah.
Yeah.
So if
Yeah.
you're completing a review that for an association that is not unavailable, and you approve the condo, do you then, if it's a Fannie loan, for example, do you then log into CPM and actually go through that process each time to update that
Only if it's
association?
full review.
If
Only
Only
if
if
it's
it-
full
okay.
review, you have to do the certification.
Right.
Okay,
Right.
and when you certify that,
Yeah.
how long is that valid for?
Year? Is it
A year.
Yeah,
A year.
About 1 year. That's
Or-
great.
However long the MCOI lasts. We'll usually use our
Correct.
expiration date as
Okay.
whatever date the current policy period on the MCOI expires.
The
Right.
master, the
master, yeah.
insurance. Ah, okay. Okay. That's great to know. And that should then feed through the findings.
I don't know.
I
Well,
haven't
yeah, I
seen
don't
it yet. It's a pretty new feature.
Yeah.
Yeah.
Okay. Okay. That's
If you do check CPM, it will show you the US the lender have certified the project.
And yeah, if it is a CPM approved, which they're few and far between, but that is the golden ticket. To Wendy's point, you just have to code it a T. When you go to deliver it, you have to make sure you're coding it correctly, that they know it's approved, or they're just going to somebody's going to kick it back. I haven't done PAR yet, Wendy. I saw it though, but I think you have to sign up for it.
Yeah,
Right.
PAR is cool.
Yes.
And
And they're about to,
Hey.
starting in December, they're gonna have a similar CPM, so you can certify your own projects with
Right.
Freddie.
So yeah, okay, good. Yeah. I'm sure they
Okay.
don't have too many on there yet, right? They're just kind of getting the ball rolling with that. So they don't, yeah. Because I've always
They don't
used
have,
CPM.
right, they don't have as
And
many as
Freddie-
Fannie.
Right, Freddie has always accepted CPM. So that's a point too. Freddie will accept Fannie Mae CPM because
Right.
they
correct.
never had their own system up until now. And before they didn't even care, but now they also want to see it and a full review. They want to see a CPM, and it's Freddie. So
And their messaging certs, if they have color coded, if it's a green, yellow, or a red review, those show up on the Freddie Mac messaging as well when you run an LPA. So you know if you potentially have an issue, or so far so good.
yeah.
right.
I think from a sales standpoint, from an LO standpoint, I think reading the findings is probably going to become more and more important, especially with automation and approvals. I believe, Kathy, you and I had one recently where it was a Fannie to Fannie refi, and
Yeah.
for some reason it listed some type of like streamline approval because it was a refi from Fannie to Fannie.
That was the first time I ever saw that. And doing this 4 years, I never saw that before. So it was a Fannie to Fannie under 80, and DU came up and just said, waived, the warranty is waived, no docs required or whatever. And I kept looking at it, and then I went in and I saw, if you go where Fannie says, you know, the 2 to 4 and the detached and all that are waived, if you go down, it says Fannie to Fannie. I don't think I ever saw one before like that. And maybe when I'm doing them manually, I just never really looked at it, because I'm never sure where we're actually going to sell it sometimes. But
Right.
yeah, that was interesting though, Sean. That was good.
Yeah.
Yeah, it helps to read the findings sometimes, you know.
Right. I
Sometimes
would
you'll
think,
find
right.
that you don't need an appraisal.
Right.
Or
Yeah.
you need
Yeah.
proper data report.
Yeah, exactly. Anything to make the process easier for everybody involved, for sure. All right, so anything else on I'm just looking in the chat here to see if anything came up in regards to the questionnaire till we get to the final section here. All right, someone just mentioned the questionnaire and the budget are needed by the appraiser to complete their report. I believe one of those on appraisal. That's a good point. Someone asked about the condo desk. I think, Paul, as you mentioned it, some companies do have a condo desk that you can reach out to and be proactive. Great. So let's move on to the critical repairs. And obviously this being, I think Pavels had mentioned a will a few years back, both for limited full reviews. And Kathleen, we'll start with yourself about so when the questionnaire or the appraisal flags the critical repairs, how do we as a lender determine whether the project is financeable or not, or is that just complete hard stop, no go?
So it depends. So some of the questionnaires, they will respond to the questions about critical repairs. Most of them will not. To Pavel's point, they want to fire up and they want to give us some kind of vague answer. So I guess the easiest is if they do respond and they say there's no repair. Our questionnaire for specific questions to those, if they answer those, there's nothing, fine, nothing else to do. However, if they come back and they say, yeah, there's a special assessment because the roof needs to be repaired. There's a special assessment, then I have to dig a little deeper. Then I'm going to go in and say, well, is it capital improvement? You know, you're just upgrading because the roof has seen its lifetime, or is it, you know, deferred maintenance?
Right.
And then you take it from there. Then you're dealing with the HOA or the condo place. And you know, if they say, oh, you know, like sometimes they word it like, you know, there was no leaks, but it's at the end of its lifetime. And then I'm always trying to figure out, what are they trying to tell me? Am I trying to read between the lines here? But if they say, you know, it's leaking, or, you know, there's water intrusion due to construction being bad, or anything that's going to lead down the path of a critical repair, then we need to know that it's been fixed. Right. So then a lot of times they'll say we're fixing it. Like, you know, we're in the middle of putting the roof on. And I'm like, okay, well, come back when the roof is done and we get something. I'll take something straight from the HOA saying the repairs have been corrected.
Yeah.
If they say, yeah, they're all set, we're all set, it's done, I don't go any further, look for any other reports. I just take their word for it. And that's usually not been a problem. If they haven't corrected them though, and they can lead to deferred maintenance, then yeah, it's a hard stop.
And to be clear, does anybody want to comment on, because I have seen that myself, the lawyer up language, and whether that in itself is acceptable for us, or do we dig deeper and ask for minutes at that point, or
Right.
or what
You
do we
have to
do at
get
that?
something.
Yeah, I would
Okay.
ask.
These will not accept that they won't give any information and that you just ignore it and keep going. You have to have something in the file.
Right. And then when you get the minutes, a lot of times the minutes are not the most recent because they
Right.
don't have this sometimes, or they don't take minutes, or they're old, you know, and then now you're like, okay, now what? Now at that point, I reach out and then I tell them, you have to answer my 5 questions. You know, there are no minutes. I can't do this, but right, your other options are minutes. Then you have to make sure you look at the minutes and not just shove them in the file, because then you're like, sometimes I look at
You have
minutes,
something in
opens up a whole nother can of worms, right? Oh,
Yeah.
really? I didn't know all the balconies were falling down, and you know, I didn't know everything needed to be the whole envelope of the building needed to be restructured, or like you'll see stuff that you don't want to see. And I've had investors come back for the little nitpick thing.
Yep.
I don't know if you guys are aware of Mr. Cooper, but they come back with every single little thing that they can find. So yeah, you got to make sure you're reading those minutes still.
And just to be clear, did this addendum all generate out of the Surfside condominium collapse in Florida? Is that when this
Yes.
all came
Yes.
about? Okay.
December 2022, it's burned into my brain.
But
That's-
before that, we didn't care if the building was gonna fall down. Who cares, right?
That's the date when you were employed as an engineer.
Yeah.
Some of those reports are hard to read.
Yeah.
Yeah.
Yeah. Well, we're insurance agents, CPAs, attorneys, and engineers.
Yes.
You guys cover a lot of ground here. Fantastic.
But also what I would say too, with not getting the answers because of the legality of it, and they just really push back and will not answer. I will get the sales involved and I will say, we have to find a board member. Because a lot of the times too, the board, they just hire these management companies thinking, okay, we've taken that off their plate, but they're also not understanding, wow, they're not answering these questions and this is what's happening. And you could get somebody potentially on the board that will answer those questions, not knowing that the management company is just absolutely not answering.
Understood. And Pavels, what kind of documentation can we request when these items do come up?
So, you know, if you have just a questionnaire, important thing is to see if they have reserve studies done in the last 3 years, right? That's the big engineering looking report that's usually 100 or more pages long that we have to read through every line. Those reserve studies will usually, set out a plan for the HOA, what they need to repair, how much money to allocate to certain things, how soon, what's critical, what's not. And sometimes when you read through those reports, you'll find that, certain things they're working on are not in fact critical, or if they are critical, right? If you find things that are critical, unfortunately, you're bound to verify they've been completed. Let's say if you have reserve study from 2022 and it says, those 3 things are critical and they need to be done by 2025. You have no choice but to verify that they've been completed. And many investors will not just take a word for it. They will want to see, invoices.
Or post-work inspections.
Yeah.
Yep.
That's becoming a big thing now.
Yeah, so you have to have like tangible documentation showing that the repairs have actually been done. Other documents, any type of engineering reports outside of reserve study can be helpful as well. The Florida has the 40-year certification. If you have a very recent one, it gives a clean bill of health. That's a good reinforcement that there's no structural issues or that they have been remedied. Let's say, if they took out a loan 2 years ago to fix something that's really, structurally bad, and you need proof that it has been fixed. Well, if they do have 40-year inspection after that loan, that means they have fixed it, that,
Right.
they're compliant now. Other things is at times, when they do lawyer up, minutes are not available, if it's especially a smaller project, there's not a lot of ways to get that information. The town's planning building departments can, verify if they have any violations or if they have any issues. That's another option that we have utilized before. Not a very popular option, but when you don't have a lot of option, you have to exhaust all of them.
And reserve studies are only good for the last 5 years, I think. And then a lot
It says within the last 3 years.
3.
Yeah.
three or
Yeah.
5, 3.
3.
Okay, yeah.
Yeah.
Right. And most of the ones I see don't have reserve studies. I'll see a reserve study, a one-off maybe.
It's
Same.
usually the larger projects that have them,
Large projects, yeah, but yeah,
Yeah.
even those.
big buildings.
A lot
I
more of
always
them have them now with
Right.
the more
Yeah.
critical repairs from the GSEs. You see them more often now.
It's like
I looked on
Florida,
that.
we do land in Florida, and it used to be
We don't
the
know.
Wild West. And now it seems like they're getting easier and easier because these HOAs have been forced to, get their reserve studies, get their 40-year inspections, a lot of them becoming compliant and Fannie Mae approved, to be honest, that I'm seeing lately.
Well, they passed laws in Florida where it was required that they
Right.
have a reserve study by the end of 2024, and new legislation in California in regards to decks that was another thing. So all the
That's like the
California projects.
SBLA, right? Or something like that, SBLA report or whatever that's called for California. Something like that. Yeah, the balconies and decks.
Oh, thank God we don't lend in Florida or California, Sean.
Lucky.
Now,
You have to
what
hire
if some of these critical repair items do come up, they're structural, but I mean, let's say, for example, there's some decks, but the units indicated that have the issue are not our borrower's unit. Is that something that we can then kind of move forward with, or is it because it's impacting the association that it's a red flag?
That's a tough one.
It's a tough one. Multiple buildings, maybe you could look at that differently. It has to be just one or two. Really, I always like to say a couple of units, but
Okay.
It's their whole HOA. It's really
yeah,
the
because we
buildings that-
really are warranting the whole HOA.
That's
Yeah.
true. That's true. Okay.
Yeah, it's also about, financial health of the whole thing, right?
Yeah.
So they have the crumbling balconies and they all need to be replaced, it's gonna affect everybody, even if you don't have a balcony.
Yeah,
Understood.
you almost have to see the whole picture. Like sometimes we'll have like reserve studies that will, had said in 2023, these were critical. You had to have done the decks. They still haven't done the decks. It's like, and like to your point, Sean, it's only a couple of units. Well, I don't trust the fact that they're going to get those decks done anytime soon.
Yeah.
Because in 2000, you know what I mean? So it's,
Sure.
you just have to use critical thinking. That's why I don't think AI or ChatGPT is ever going to take over condo review. There's no way. There's no way. You need a human.
Job security.
You have to be a detective sometimes.
Correct.
Like
Yeah.
Kathleen said,
Yeah.
those meeting minutes bring up so much.
So much.
And
Yeah.
they often are the
How
one
many
thing.
jobs are we at now? 5?
Phone up.
No, we're detectives.
Back and I'm like, let me see if this is going to get reviewed and the investor's going to ask for them. You know what I mean? Like, I know
Yeah.
I need them and I know I've looked at them.
Right.
But some, let's face it, you throw the file in, you're like, oh, please God, I hope nobody reviews this file. So they might not come back and ask for them, but 9 out of 10, they're like, yeah, I just got 2 kicked back because they wanted more information.
Yeah. This, from a sales standpoint, this is tough too. I've been making a lot of notes, but, and correct me if I'm wrong, but I think that there's some very like major questions that we can try to vet up front as best as possible. And that would be, are there any major critical repairs, right? Structural repairs, any pending litigation that they're aware of, obviously the budget and the financials they may not know about, and the master insurance. And then
Right.
in addition to that, you got all those other red flags that Pavels mentioned in regards to the owner occupancy, the single entity ownership, so on and so forth. Yeah, it's a challenge, but appreciate everybody's insight on this. And we're coming up here on 11 o'clock and want to be
I don't see any
respectful of
other
everyone's
questions.
time. Yeah, if anybody has any additional questions, thank you again to the panel. That was fantastic, but we'll give it a minute or two to see if any additional questions come in. The expertise that you guys have and the many jobs and hats that you wear, I I don't envy your position, that's for sure.
One tip when single entity ownership, if someone owns a lot of those units, check to see if any are being marketed, actively
Right.
marketed. Because if they are, you
sale.
can take those out of the mix.
Right. If they're dissolving their ownership, right? Yep.
Correct.
Okay, great. Excellent.
The thing about delinquency as well, things change and people get caught up on payments. So
We always double check on those too, because sometimes you check back in a week or two and somebody's made their payment, so you're able to meet that requirement.
we've had one recently that we were able to warrant because 2 people caught up while we were trying to solve for it.
Yeah. And being educated from a sales perspective on this is very, very important because again, relaying this information to the borrower, to the realtor, and being the trusted professional, it's not easy, right? We all know that. You guys are doing your jobs, you're writing the loans to the guidelines and then trying to relay that back, especially to a first-time home buyer. purchasing a first condo, it's not easy, right? So being educated about this is very important, and also understanding that, you know, what we've talked about today is, you know, Fannie Freddie, the standard GSEs, right? So there's a whole nother world for non-warrantable condos, whether that's investor base or portfolio, what have you. And it's great to have those alternative options for the buyers that are willing to take on some, you know, perceived risk, but still want to finance and move forward and purchase a home. There's certainly options available there. Today's call was specifically, you know, to the GSEs, which is probably still 50% of the business in the United States, give or take. So, any other questions? Thank you. Very helpful, Kate Man. Well, that's a nice note from Liz Stevens. Thank you very much.
She's amazing.
And one way to potentially escape the whole critical repair is,
FHA.
does your borrower qualify for FHA? Is it an FHA warrantable project?
Yep.
Because they don't have
Okay.
the critical repair requirements. Obviously, though,
No.
if there's something major going on the project, you're probably
Right.
not
You
gonna
want
go
to
there.
make that. Yeah, you want to
Right.
make sense of it. But
Exactly.
they also don't require the like if you have the per unit deductible and they just will not add that endorsement, they don't require that as well. You just have to have 100% replacement costs.
The inflation guard is not a big deal either.
Correct.
Hmm.
We've had to do that a few times with borrowers, flip them over to FHA.
Do you guys run into a waiver of rights of recovery issue on master insurance? It's a coverage that's required by both Fannie and Freddie if you look at the guidelines.
For
Indeed.
limited and full?
Yes.
What's
I
it
know
called?
that a lot of people don't catch on it, but
Yeah, the waiver of subrogation.
I've had CPM ask for it when I tried to rebut insurance, so the agencies do look for it, and we have been looking for it, and a lot of agents say, I don't know what it is. I'm having to ask for a full policy to find it, but I just wanted to know what the other's experience has been with it. It seems like it's there in the guidelines.
Haven't
Some
bumped into
people
it.
look for it, others don't.
Yeah.
Great. Well, Sarah, unless you have anything at all, I'll give everyone their 3 minutes back, and thank you again. It's a fantastic panel and all your expertise, and wish everyone the best of luck in continuing to help buyers purchase affordable housing in Massachusetts, specifically with condos. So
And
thank you
Sean-
everyone for your time.
Sean,
Yep.
thank you. Thank
Thank
you
you.
for
Oh,
putting
my
together
Sean, thank
and
you all.
moderating and
Pleasure.
the
Nice
panel.
meeting you, everybody.
My
Yeah,
pleasure.
nice meeting
everyone.
everyone.
My pleasure.
Bye.
Thank you very much, guys.
Thank you.
See ya.
Thank you, participants.
Take care. Have a
Bye-bye.
great day. Bye-bye.